Hi, this is Skyler with Regan Capital. It's taken a little bit for us to digest what happened this week with the Fed meeting, but let's take a rewind and look at what the Fed said, what the Fed is predicting, and where we think the market's going to go. So the Fed left rates unchanged, but when you listen to their press conference and you look at the reaction over the last few days, the market looked at what the Fed is saying, what they're doing is fairly dovish, i.e., there's 2 to 3 Fed cuts actually priced in between now and the end of the year. And you can see that here. This is FED on Bloomberg. You could see here Fed rates are at 433, but by the end of the year, this is September. September has a little bit over 1 Fed cut priced in. And if you go out to the end of the year, which is December 25th here, there is upwards of about 2.5, almost 3 Fed cuts priced in. Okay, so we're at 4.25 to get down to 350. We almost get there in December, January. So you have 2.5, almost 3 entire cuts priced in between now and the end of the year. Is that possible? And what exactly is the Fed saying they're going to do? So let's take a look at the dot plot here. Okay, so this is just updated. They only update this at every other meeting. And so the median has those Fed fund rates at pretty similar, about 390 instead of 360. Market's down here. The median is here. Okay. And you can see, you can add this up. You have 9 folks here, 2 folks here, but you have 8 folks, almost half, that are saying they're not going to move. And if anything, you have 4 folks that are saying rates might actually rise from here. Okay, so that's really interesting. So what's driving all of that? Where do we think, and where does the Fed think the inputs into moving interest rates, Fed funds rates, are going? Okay, so some really interesting inputs here. And what we're looking at is where we were 3 months ago versus today. Okay, so the Fed is basically saying, okay, GDP is going to drop a little bit, bad. Unemployment's going to move up a little bit, bad. Okay. But also inflation's going to rise. Okay. So instead of getting down to 2 or sub 2%, which is where they want inflation to go, inflation's actually going to go from, call it, 2.5 to 2.75. Okay. We can see their preferred inflation gauge, which is PCE, moving from a range of 2.3 to 2.6, 2.6 to 2.9, and not getting below 2 really ever. And so the Fed's saying inflation's never going to be under control. Okay. Now, what's it going to take for the Fed to actually drop interest rates? Inflation needs to get under control, and or employment needs to go up precipitously. And they're saying employment is going to go up from, call it, 4.3 to or 4.2 to 4.5 to 4.3 to 4.4. Actually a tighter range. Okay. And long term, they're actually seeing employment's going to drop. Unemployment rate's going to drop. Okay. So neither of the two inputs into dropping interest rates are improving, i.e., lower inflation and worse unemployment. So if anything, okay, if anything, the Fed might be raising rates next. Okay. Because if inflation isn't becoming under control and unemployment is stable and the economy is relatively stable, the Fed might actually have to raise rates this fall. So looking at a couple of other things that we don't pay much attention to, but Fed funds rate central tendency. Look again here. Okay. So this range is saying 3.6 to 4.1. They're actually raising their estimates of Fed funds rates. Okay. So let's look at the consumer. So this is University of Michigan long-term inflation expectations. Okay, 5 to 10-year inflation. It just shot up from 3% to 3.9. Consumers think that inflation is actually going to be 4% long term. Let's look at this over the last 5 years. Highest rate ever. Let's max this out. Highest rate since 1991. Okay, when George H.W. Bush was president. Okay, and you can see how crazy it was back in the early 80s. So highest rate in a very, very, very long time. Yet the market, for whatever reason, is saying the Fed's going to cut 2 to 3 times this year. Okay. So let's look at the curve. So I'm going to go to the Wayback Machine, the flux capacitor, and say, okay, well, where was the Fed position when they last cut interest rates, which was September 17th, roughly 6 months ago? Okay, you had this very inverted curve. Fed funds were at 5. Since then, they've cut roughly 100 basis points, okay, 5.25 to 4.25. But what's happened with traditional fixed income, this traditional fixed income has actually moved up and lost money. It's lost a few percent over the last 6 months. Okay. What does this all tell us? Where do we want to be positioned? And this is updated for today. We have current yields. You have a very, very, very flat curve. You have 1 year futures. Futures rates are actually expected to rise, or medium term rates and long term rates are actually expected to rise. The front end's supposed to come down as those futures tell us. Okay. So you're much better off being in the front end of the curve than being in the belly of the curve. Okay. Stay short, stay floating rate. Our next move could be back to where we were at the beginning of the year. Let's go to the beginning of the year, if not worse. Okay. So 12/31/24, the curve actually steepened out a lot. You were getting almost 5% on 20-year paper. Okay. Fast forward today, we're down 35 to 40 basis points in the belly of the curve. Okay. So now's the time to actually stay here, stay floating rate. You can get over 100 basis points over short term interest rates in agency government guaranteed paper. You can get 5.25, 5.35 yield in agency government guaranteed paper. And there's a lot of other places to be where you can stay short and wait for long term rates to rise. Thanks.